Right, Square, new series. Let's kick off.
September 2023. The platform goes down, every product, every service. Merchants cannot process payments. They find out through social media, not from the company. 15 hours. One merchant estimates 8 to 10,000 in lost revenue from a single day. The outage is not the defining horror story. The defining horror story is the account deactivation. Account terminated without warning. Funds held for 90 days. Support provides scripted responses. No escalation path. November 2025, 20,000 held on a merchant with 0 chargebacks. Support refused to escalate. Review deferred 3 months. For a small business that depends on cash flow, having its money frozen for 90 days is not risk management. It is the kind of crisis the platform's simplicity cannot prevent. Square. Founded because a glass artist lost a sale. The easiest processor to start with, not always the easiest to live with at scale. Jim McKelvey was selling glass artwork and lost a sale because he could not accept a card payment. He told Jack Dorsey about the problem. They built a small card reader that plugged into a smartphone and an application that processed payments. The insight was that the smartphone was already in every merchant's pocket. The card network infrastructure already existed. The missing piece was an affordable hardware bridge and a merchant account that did not require the traditional bank relationship. The company launched in 2009. The initial differentiators were flat rate pricing rather than complex interchange schedules, instant deposits, and no monthly fees. The public offering came in November 2015 on the stock exchange. In December 2021, the company renamed itself. The payment platform became one brand inside a larger entity that also operates a consumer money transfer application with 60 million monthly active users. Revenue across the parent company grew from approximately 22 billion in 2023 to 24 billion in 2025. In 2025, the parent company paid 80 million in multistate regulatory fines and 40 million to a single state regulator over compliance failures in the consumer application. In 2026, the company conducted significant layoffs as part of an efficiency restructuring. The company that launched with card acceptance for everyone is now a regulated financial institution navigating compliance at scale. The account deactivation pattern is the most consistent complaint across the research period. April 2024, approximately 31,000 held for 90 days after deactivation. September 2024, funds held for 90 to 120 days with the merchant unable to transfer. May 2025, an account deactivated immediately after an approved charge. November 2025, 20,000 in reserves held on a merchant with 0 chargebacks. Support refusing to escalate. Review deferred to February 2026. The pattern is not isolated, it is structural. The platform processes payments for millions of small businesses without requiring the underwriting process that traditional merchant accounts involve. The trade-off for that ease of entry is that the platform reserves the right to terminate accounts and hold funds when its risk systems flag a concern. The concern may be legitimate fraud, it may be a sudden increase in transaction volume, it may be a category the platform's risk models consider elevated. The merchant receives no advance warning, the merchant has no effective appeal, the funds are held. The business absorbs the impact. The September 2023 outage exposed the infrastructure dependency, 15 hours of downtime across all products. Merchants with no secondary payment processor had no way to accept payments. The company published an incident summary identifying database infrastructure failure as the root cause. The communication failure was separate from the technical failure. Merchants learned about the outage from social media rather than direct notification from the company whose platform their businesses depend on. The product itself is strong for the businesses it targets. The point-of-sale software is free at the entry level. The hardware works reliably. The card reader, the terminal, and the register cover the range of in-person payment needs. The vertical software for restaurants, retail, and appointments solves workflow problems specific to those industries. The banking services provide checking, savings, and lending under the same account. The invoicing, the online store, and the payroll add capabilities that a small business would otherwise source from multiple providers. The pricing is transparent and flat rate, a fixed percentage plus a small per transaction amount for in-person payments, higher for online transactions. no monthly fee to start. The transparency that made the pricing attractive to small businesses becomes a cost disadvantage at volume. A merchant processing significant monthly volume at the flat rate pays meaningfully more than the same merchant would pay on an interchange plus model from a traditional processor. This is why merchants often leave as they grow. The platform is designed for the merchant who is starting. It is not always the most cost-effective choice for the merchant who has scaled. The consumer money transfer application integration connects the merchant and consumer sides of the parent company's ecosystem. Customers paying through that application at the merchant's point of sale create a closed-loop transaction that benefits both sides. The integration is the parent company's strategic play. The payment platform, the consumer application, and the banking services form an ecosystem whose value increases as the merchant uses more of its components. Someone starting a small business who needs to accept card payments with minimal setup and no monthly fee should consider this platform. The onboarding is the fastest in the comparison. The hardware works on arrival. The software is intuitive. The ecosystem provides payment processing, point of sale, banking, invoicing, and payroll under one account. For the merchant who wants to accept their first card payment tomorrow, the platform delivers on the founding promise. Someone whose business depends on cash flow should understand the deactivation and fund hold risk before making the platform their only payment processor. The 90-day hold pattern is documented across multiple cases with merchants who had no prior compliance issues. A secondary payment processor that can accept transactions if the primary account is deactivated is not paranoia. It is business continuity planning. The platform's ease of setup makes it easy to forget that the same company can freeze access to funds with no warning and no effective appeal. Someone processing high volume should evaluate whether the flat rate pricing remains competitive as the business grows. The percentage fee that felt simple and transparent at low volume becomes a measurable cost disadvantage relative to interchange plus pricing models as volume increases. Merchants who process above a certain threshold typically find that traditional merchant accounts or enterprise payment platforms provide the same transaction capability at lower cost per transaction. The platform is designed as a starting point. The pricing reflects that positioning. Someone evaluating the platform for a restaurant, retail store, or appointment-based service should look specifically at the vertical software. The industry-specific features for those three categories address workflows that generic point-of-sale software does not handle well. Table management, inventory tracking, and appointment scheduling are capabilities built into the paid vertical tiers. The vertical software is the product layer that differentiates the platform from simpler card acceptance solutions. The platform that Jim McKelvey and Jack Dorsey built because a glass artist could not accept a card payment has, in 17 years, become a regulated financial institution inside a parent company with $24 billion in annual revenue. The founding insight was correct. Card acceptance should be simple and available to everyone. The platform made it simple. The risk that accompanies the simplicity is that the same ease that lets a merchant start processing payments in minutes lets the company terminate that merchant's access in minutes with the funds held for months. The product works, the ecosystem is broad, the pricing is transparent. The account deactivation risk, the fund hold pattern, and the absence of an effective support escalation path are the edges that accompany the simplicity. The glass artist's problem is solved. The merchant's dependency on a single platform to hold and release their revenue is the problem that replaced it.